IAS 21, the effects of changes in foreign exchange rates, establishes the accounting principles for recording foreign currency transactions and translating financial information when entities operate across multiple currencies. In an increasingly globalized economy, businesses frequently engage in international trade, foreign investments, and cross-border financing arrangements. Exchange rate fluctuations can significantly affect profitability, asset values, liabilities, and financial performance. IAS 21 ensures consistency and comparability in accounting for these effects by establishing rules for determining functional currencies, translating foreign currency transactions, and reporting monetary and non-monetary items. Within the DIP-IFR syllabus, this standard is important because multinational operations and international transactions require careful treatment to ensure that financial statements faithfully represent economic reality and foreign exchange risks. A key concept under IAS 21 is the distinction between functional currency and presentation or reporting currency. Functional currency is the currency of the primary economic environment in which an entity operates and generates cash flows. It reflects the currency influencing sales prices, labor costs, operating expenses, financing activities, and cash retention. The reporting currency, however, is the currency in which financial statements are presented. An entity may choose to present financial statements in a currency different from its functional currency for reporting or consolidation purposes. Distinguishing between these currencies is essential because functional currency determines how transactions are measured initially, while reporting currency governs how financial statements are translated and presented to external stakeholders. Determining an entity's functional currency requires professional judgment and evaluation of several economic indicators. IAS 21 identifies primary indicators such as the currency influencing sales prices of goods and services and the currency mainly affecting labor, material, and operating costs. Secondary indicators include the currency in which financing activities are conducted and the currency in which operating cash receipts are retained. In some situations, determining functional currency may be straightforward, while multinational entities with operations across different jurisdictions may require detailed analysis. Once determined, functional currency is applied consistently unless underlying economic circumstances change significantly. Proper identification is important because incorrect functional currency selection can distort financial performance, foreign exchange gains or losses, and overall financial statement comparability. IAS 21 requires foreign currency transactions to be recorded initially using the spot exchange rate between the functional currency and foreign currency at the transaction date. Transactions include purchases, sales, borrowings, investments, and other arrangements denominated in foreign currencies. Initial recognition converts foreign currency amounts into functional currency to ensure consistency in accounting records. Subsequent settlement differences arising from exchange rate fluctuations create foreign exchange gains or losses recognized in profit or loss. This approach ensures that financial statements reflect both the original transaction value and the economic impact of exchange rate movements occurring between transaction dates and settlement dates. Accurate transaction recording, therefore, contributes to transparent reporting of international business activities and associated currency risks. At each reporting date, IAS 21 requires monetary items denominated in foreign currencies to be translated using the closing exchange rate. Monetary items include cash, receivables, payables, loans, and other assets or liabilities to be settled in fixed amounts of currency. Exchange differences arising from retranslation are generally recognized in profit or loss during the reporting period. This treatment reflects the fact that settlement amounts will vary depending on current exchange rates. The requirement ensures that financial statements present up-to-date values for monetary obligations and resources exposed to currency fluctuations. Foreign exchange gains and losses can significantly affect profitability, particularly for multinational organizations operating in volatile currency environments or holding substantial foreign-denominated financial instruments. Non-monetary items are treated differently under IAS 21 because their settlement does not involve fixed or determinable amounts of currency. Non-monetary items measured at historical cost, such as property, plant and equipment or inventories, are translated using exchange rates existing at the transaction date and are not subsequently retranslated. However, non-monetary items measured at fair value are translated using exchange rates at the date when fair value is determined. Exchange differences associated with fair value changes are recognized consistently with the underlying gain or loss, either in profit or loss or other comprehensive income. This distinction between monetary and non-monetary items ensures that accounting treatment reflects the economic nature of assets and liabilities appropriately within financial statements. Overall, IAS 21 provides a comprehensive framework for accounting for foreign currency transactions and exchange rate fluctuations in international financial reporting. By distinguishing between functional and reporting currencies and establishing consistent translation principles for monetary and non-monetary items, the standard enhances comparability, transparency, and faithful representation of multinational operations. Accurate accounting for exchange differences is essential because currency fluctuations can significantly influence profitability, financial position, liquidity, and investment decisions. The DIP-IFR syllabus emphasizes that understanding IAS 21 requires both technical knowledge and professional judgment, particularly when determining functional currencies and applying translation rules in complex international environments. Proper application of IAS 21 supports reliable financial reporting and informed decision-making in global business operations.